And what's happening, options traders? Good morning, everybody. I thought it would be helpful during these volatile markets to talk a little bit about the unwanted surprises that can happen with stop limit orders. And in these volatile markets, it's a tactic that a lot of people are using, stops and stop limits. But if you're not aware of the mechanics of the stop limit order, you can definitely end up with an unwanted surprise. So what is that, and how do you avoid it? Well, first remember there are two basic types of stop orders. There's your regular stop order, and that's going to convert to a market order if it's triggered. And then there's a stop limit order, and that's going to convert to a limit order if it's triggered. However, if you're using the stop limit, traders often forget that they still have an open limit order. This is the big unwanted surprise. And so we'll take a look at how that happens, but just remember when you use a stop limit order, the computer is going to send a limit order if it's triggered. So let's take a look at an example. Let's say that you buy shares of stock for 100 and you say, well, I'm going to place an order to sell at a stop of 98. And just in case the stock really takes a big hit, remember we're in some volatile markets, I don't really want to sell it below 95. If for some reason the stock gaps below 95, I would have some confidence that it's going to come back. So I want to get sold at around 98, but if I can't get at least 95, I want to continue holding my shares. So to do that, you place a stop limit of 95 or whatever that price might be. Now, because this is probably not going to execute now, traders usually make that a GTC or a good till canceled. The most important thing to remember, whether you're using a regular stop or a stop limit, is that the stop price, 98 in this example, is nothing but a trigger. Sometimes traders think that that's the price that they're guaranteed to get. That would be too good to be true. That would be a free put option. It's just a line in the sand saying that if the stock price touches this or crosses it, we're going to trigger the order. So in this example, if the stock trades at 98 or lower, the order is triggered. And that's important to remember the or lower part. That's just part of the rules for a sell stop. So the stock could come down and just touch 98 even for a second, or it could gap down to 70. And in both of those cases, it has triggered the order. And so for this example, the computer would then submit a sell limit at 95. And if you can get 95 or higher, the computer will sell the shares for you. And if you can't, you'll just continue to hold the shares. So here's an example of how it might work in a perfect situation. Kind of what you're thinking in your head is probably how it's going to work. Stock is at 100, it starts slowly moving down, and then it touches 98. What happens? It gets activated. The computer says it touched our trigger order or our stop order. So it activates the order. Computer does what? Places an order to sell at a limit of 95, good till canceled. So if the stock is at 95 or above, you're probably going to fill now. If it's below, you're going to end up holding the shares. But remember, that's what you wanted. In your view, if you couldn't get 95, you'd rather hold the shares. So that's kind of the perfect setting. So where can it go wrong? Well, here's where the unwanted surprise comes in. Let's say that instead of the stock slowly moving down and touching 98, it just blasts right through it, maybe even off the opening bell. And the stock is trading down at 90. Well, what happened? The computer said it traded at or below 98. So let's submit an order to sell at a limit of 95, good till canceled. So you get up one morning, you find out the stock's trading at 90, and you say, oh, I'm so glad I put on my stop limit because I'd rather hold the shares. I have confidence that they're going to come back. And it starts slowly working its way up. And you're going, hey, this is great. This is exactly what I thought was going to happen. If it gapped well below 95, I'd rather hold the shares. And so this is what you got. And it starts moving in your favor, and then suddenly it touches 95, and what happens? You get sold because you forgot there was an open sell limit order. And then the stock continues to blast right through there, and now it's trading up at 140, and you go, oh, I'm so glad I used that stop limit. Let me go and place an order to sell, and you look and you say, oh, that was sold 2 months ago. You're going, I never sold it 2 months ago. What happened? And you look and you find out there was this open sell limit. So the whole moral of the story is to remember that if your sell limit order gets triggered, you have an open sell limit on the books. And if you don't want that, you need to cancel. The broker can't read your mind and figure out if that's what you actually wanted or not. But you definitely need to remember that it's there. The last thing that you need in these volatile markets is to find out that you were right for using a stop limit, but still missed out on profits. For anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.